Now let's start in South Africa, where more than 2,000 workers at Anglo-American Platinum ended a two-day underground sit-in protest. Now members of the militant AMCO union started the protest at Amplat's Dishaba mine on Saturday morning after one of their leaders was suspended for breaching safety regulations. The two sides have reportedly settled their differences, with Amplat's management issuing a statement saying they will not negotiate with employees allegedly engaged in illegal activity. The company at the same time strongly warned that action will be taken against those who instigate such behavior and activity in future. Amplat, however, says no production has been lost as a result of that strike. Also in Southern Africa, a labour disagreement between the Zambian government and that country's largest copper mining firm has resulted in the government cancelling the company's CEO's work permit and refusing him entry into the country. Zambia's Minister of Information and Broadcasting, Wanseka Pair, told Bloomberg News that Kishore Kumar, who became chief executive of Konkola Copper Mines in August, will not be allowed back into the country over claims of arrogance. Now, Zambia's government has criticised the company after it announced plans to fire some 1,529 workers in order to cut costs as it shifts over to more mechanisation. President Michael Sat on the 4th of November threatened to cancel the company's licence if it dismissed any employees. The state-owned Times of Zambia newspaper then reported 2 days later, on the 6th of November, that the company had fired some 76 workers effective 19 September under the headline KCM Defies SATA. Let's get some reactions to you from this story. CCTV's Miriam Bemard is live in London tonight. Miriam, given the fact that Zambia is heavily reliant on quite a bit of FDI flowing into it, and KCM really is its biggest FDI source, what reactions has this incident drawn over in London?
Rama, not good ones. Investors are certainly taking a more cautious stance on Zambia. Let's not forget, this is not the first time the government has made threats. Just last month, a similar ultimatum was out against South African retailer ShopRite. This came after it announced a trim of about 6.7% of its workforce by next year. And many on this side are really saying the government and the firms need to sit and discuss new terms that work for all parties involved. Investors and lenders may find it difficult to invest or do business in a country they see as a risk investment destination. At the same time, experts say that countries that have a high debt portfolio are less likely to be able to carry out development projects with resources essentially going to service the debt. And the longer Zambia sustains over $3 billion in debt, the less it will attract investment money for new projects.
Indeed. Speaking of resolutions, though, in the ShopRite versus Zambia's government row, we saw ShopRite eventually backing off on plans to fire some 3,000 workers. So what are the odds, really, for political resolution between Zambia and KCM's owners, Vedanta Resources?
Well, that's just it. That's exactly what we're waiting. There needs to be some sort of resolution. Investors on this end are watching for a swift one, a swift agreement, more so because Zambia cannot afford to lose new foreign-funded projects, especially after rating agency Fitch downgraded its credit rating, with expectations the deficit will continue to inflate and not enough government-infused capital. At the same time, though, analysts we spoke with are gauging the long-term trends in Zambia, forecasting that output from the copper mines will start showing fruition in 2015-2016 year, when production could actually double to 1.4 million tons. That's why the common thought is that big firms like Vedanta are a barometer, really, for others in the private sector to the health of Zambia's mining industry. But as of late, Vedanta's Konkola mine, of course, as you know, was performing quite poorly, so the downsizing and cost-cutting didn't actually come as a surprise on this end.
Indeed. Finally, though, copper is a key source of hard currency earnings for Zambia. Could this dispute perhaps have any ripple effects as far as market supply and market prices are concerned?
At this point, Rama, it's unlikely to have a huge impact. In fact, the impact could be worse on Zambia itself, mostly because of a rise in copper stockpiles around the world. That's creating a surplus expected to reach about 180,000 tons this year and double that by 2014 in the 300,000 range. The other key factors at play here is China's ongoing demand for copper and its ties with Zambia. We're talking about 40% of demand there alone. Ultimately, though, Zambia needs to maintain its output without financial losses, given that copper prices are also being driven down by traders shorting the market on the view that too much supply will be coming up in the short term.
Indeed. Thank you very much for that update. That's CCTV's Miriam Bemard live in London tonight. Now, let's move on to Kenya's banking sector. In nominal terms, bad loans have gone up by about 34% or so in the year to date. In the third quarter of 2012, the comparable figure was just 18%. But the question is, how really did we get here? Well, let's go back to 2011 and what, quite frankly, is a very unholy trinity of numbers. In that year, inflation peaked at just under 20%. The Kenyan shilling had slammed into an all-time low against American dollar of 107. And in response to those two issues, the central bank then decided to jack up its lending rate. Remember, analysts at this point in time were saying it's really behind the curve. So you saw the CBR moving from 6.25% in August all the way up to 18% by the close of the year. Now, obviously, that sort of rate hike is a big problem. To avert a wave of defaults on the retail end, the Kenyan Bankers Association and the central bank sat down and said, OK, here's what we're going to do. We're going to extend the period of which these loans can be repaid. You have to essentially boost up the maturity profile instead of ratcheting up rates immediately. At the same time, we're going to cap installment hikes at 20% of what you're supposed to pay. Interesting solution. The question is, did it actually work? That brings us back to the numbers that we have just seen. As far as the third quarter results from banks that we are seeing now, probably not. In fact, what these numbers suggest is that the problem was simply deferred but not actually resolved. When you have the industry's portfolio of bad loans rising at more than twice the rate they did in the third quarter of 2012, analysts at EcoBank think Kenyan banks actually delayed in classifying loans which have gone past the 90-day threshold and therefore might actually be sitting on a significant pile of unclassified bad loans. Keep those numbers in mind. So just how big a problem is this for Kenyan banks and how much damage really should you expect to see to asset quality? And why are we seeing defaults rising in 2013 and not in 2012? Let's find out. George Bodo is head of banking research at the EcoBank Group that produced that report. He's in studio with us here tonight. George, NPLs, why are they rising in 2013 and not in 2012?
I think thank you, Rama, for this show. I think what you've just said is actually true. What's happening? You know, when between quarter 3 2011 and quarter 2 2012, when there was all the pricing benchmarks went up, eventually banks actually repriced upwards some of these loans which are easily repriceable. So what we saw is that there was, lendees, borrowers were actually having a hard time trying to keep up with their mortgage payments or whatever type of loan that they took. So they couldn't keep up the payments. So I think what we've seen is that, you know, if you look at the restructuring that happened in December 2011, what happens is that they actually literally just deferred the problem. So what you have is that banks didn't actually classify them. So what you have is that there's a salient pressure from the regulator for banks to reclassify these things. So what you're seeing, they're not new non-performing assets. These are existing non-performing assets that are actually gradually being reclassified. So that's the source of all this noise.
Indeed. Give us a sense of the lay of the landscape here. Where exactly are these non-performing loans concentrated with respect to the 40-plus banks that we have in the Kenyan banking sector?
We don't have a breakdown at the moment, but we believe that the problem lies in the SME books of various banks and the consumer books, which is the retail segment of the lending, the households, because these are the only segments of the market that are easily repriceable, either upwards or downwards. And what we saw is that there was a massive repricing upwards between 18% on average 18% to 24%, and that was massive. If you have an SME book, a huge exposure to an SME book and a retail book, they can't take in that kind of repricing. So that's too much. So you're going to have a section, a percentage of that book that's going to find it hard to keep up with the payments.
Indeed. There was another line, of course, that jumped out to me in that report. You argue that if KCB and IXD Bank had raised their provisions for bad loans to what they were in the third quarter of 2012, their profit after tax would be anywhere around 10 to 15 percentage points lower. Why are we seeing coverage ratios so far being so low among Kenyan banks?
Okay, two things here, Ram. One is banks are under pressure to report profits. And so that's why you see they keep playing around with the coverage ratios. And look, for example, Equity, which has one of the highest coverage ratios in this market, I mean, declined from 94% at the full year 2012, and at the end of quarter 3, they were doing 71%. That's a massive. I mean, it just shows the pressure to report profits. Again, it also points to the amount of how slow they're going at the pace. The slowness, the pace of trying to reclassify these loans. So that's why our view is that, as the salient pressure from the CBK apps, then if they keep reclassifying more and more, then in quarter 4 they might reclassify more of them, and then provisioning might go up again.
Indeed. Finally, George, with respect to asset quality, if NPLs do go up, that will change the perception of these two counters in the market. But we have seen KCB and Equity Bank both going up about 50% year to date, clearly outperforming the NSE 20. Is the market broadly ignoring the NPL problem, or are they seeing some salient value in these two banks? And they probably think, well, these two banks have the problem under control.
I think what the market is seeing is that the asset quality, which is the ratio of NPLs to gross loan book, is still below 10%. So they're saying, okay, still below 7%, below the red line. So they can still keep buying this. But I think a 100% jump in non-performing assets in Equity Bank, another 20% jump in non-performing assets in KCB should give them a worry. And I think if the trend maintains, then I think by the beginning of quarter 1, we'll look at the asset quality of these two banks, and by and large the industry sitting above 10%, which I think at that point they should start to discount the values of these stocks, in my view.
Indeed. We'll have to leave it there for the time being. Thank you very much for your time. George Border, the head of research at EcoBank here in the Kenyan capital, Nairobi, live in studio, talking about Kenya's bad loan problem. Now, the G20, it's seen as a significant platform for policy debates and decisions, and its support for the reform and recapitalization of the international financial institutions like the IMF has not gone unnoticed, more so in Africa. Speaking to delegates at the South African Institute of International Affairs Summit, the Finance Minister of South Africa, Pravin Gordhan, reiterated the oft-touted fact that the continent has a vested interest in the activities of the International Monetary Fund. Now, there have been renewed calls for a third seat on the IMF board, specifically reserved for Africa, to avoid the continent from being sidelined in decision-making.
In the 2010 reforms that still remain to be implemented as a result of decisions not taken in the US yet, Africa lost a percentage of its quota in the overall scheme of the IMF to larger emerging market economies, and it is quite important that in the 2015 round, where a new formula is currently being negotiated, Africa does not become once again a loser of quota, or is marginalized once again as a result of not being granted a third chair at the table.
And speaking exclusively to CCTV Africa on the sidelines of that particular summit at the South African Institute of International Affairs, the South African Finance Minister also noted that the signing of a crucial treaty on the Grand INGA hydropower project by South Africa and the government of the Democratic Republic of Congo is an enormous step forward in helping to power the African continent as a whole. According to the minister, once complete, that dam could eventually become the largest hydroelectric project in the world, generating about 39,000 megawatts of power. The project has been stalled for several years now, but it appears as renewed interest and commitment, with both countries keen on getting it off the ground.
No, I think big projects like this need to be taken in phases. First, you get the concept right. Second, you must build a consensus. Third, you must have the bilateral agreement, which we now seem to have. And now we can get down to serious planning, and there's lots of stakeholders who are ready to finance, in fact, all of it. So it's a question of how do we structure that finance to the best advantage of the project, of the DRC, and of Africa more generally as well. So from what I know, there's no shortage of offers to finance the project. We now need to move into the phase where we actually get to the design of that. Yes, eventually all of us will make a contribution of some kind, but I don't want to get into details at this point in time.
Not going into details at that point in time, but we do need some more, so let's talk to CCTV's Angelo Coppola. He's live in Johannesburg tonight. What exactly does this treaty between the DRC's government and South Africa on Grand INGA entail?
Well, let's stick to the numbers. As far as we're aware, Eskom are going to take a 15% stake in the first 4,800 megawatts that are produced. So that's a nice number. It's also undertaken to find and secure funding for the remainder of that equity position. So it's actually the construction of INGA 3. We also know that Eskom will buy the first 2,500 megawatts that are produced by this INGA 3 dam. The remainder stays in the DRC. And then we know that and this is the crucial point here, there's an offtake commitment from Eskom that it will take 30%, a minimum of 30% of any excess or future power generation on any agreed phases that happen post. And that offtake agreement is key because backers and funders and financiers and investors are looking for a credible power buyer, and Eskom is a credible power buyer. So quite possibly this is going to be the trigger that will see that first brick or piece of concrete laid in 2015. Raman?
Indeed, we have seen quite a few delays on this project, but at 39 gigawatts, that's an enormous slice of power here. Where exactly does it fall, however, in South Africa's long-term energy supply plans?
Well, as the Minister was talking this afternoon, or this morning in fact, there's a St. Petersburg action plan which the G20 put together a little while ago. And part of that is a commitment that South Africa will build that third coal-powered power station, and it needs to resolve its energy issues. And this is one of the ways to resolve that energy issue that the country has. The fly in the ointment here is the transmission lines. There's some 3,000 kilometers of high-tension lines that have to be built between INGA 3 and South Africa. It's got to cross over a couple of countries, and at the moment South Africa is talking to those neighbors of theirs to see if anybody's keen to take an off-junct off the main track transmission line, so that maybe it can offset some of the costs of putting it in here. So Eskom are in for a big deal here. They're in for the 50% equity stake. They're in for the purchase of that 2,500 megawatts, and they've got to put the transmission lines down. So they're definitely committed, and they're definitely up for the job. Raman?
Indeed, thank you very much for that. That's CCTV's Angelo Coppola live in Johannesburg, talking to us about one of the more exciting developments, really, as far as Africa's power sector is concerned. If you sort out Nigeria and you get the INGA 3 up and running, you've got practically the entire sub-region sorted out as far as power is concerned. Time for a short break. Here's what's coming up next. ECOWAS forges ahead with currency and regional integration. We'll have the details when we come back. Welcome back. Now, leaders of the 15-nation West African bloc, ECOWAS, recently concluded talks in the Senegalese capital of Dakar about the creation of a single currency, regional integration and the economic partnership trade agreements with the European Union. Following the talks in Dakar was CCTV's correspondent Desiree Canon. He spoke to an economic expert who gave insight into the resolutions that emerged from that meeting.
ECOWAS single currency initiative has been largely welcomed by many observers. Regional integration has received much support from African governments and heads of states.
L'économie de trouver sa propre identité.
The currency is an asset that allows the economy to have its own identity on the international stage. We know from economic theory that no country can develop with the currency of any other state. I believe it's time for the African countries to leave the CFA zone, which is dependent on euros. The CFA francs have now become outdated because the euro is a very expensive currency and our economies are not competitive.
Nos économies ne sont pas compétitives.
Dr. Suleiman says the conditions required for the establishment of an economic and monetary zone with a stable and credible single currency are the harmonization of domestic economic policies, mainly monetary and fiscal policies, harmonization of national statistics, free movement of goods, services and capital. According to experts, having various currencies in the sub-region is an impediment to sub-regional integration and economic growth. But what are the benefits of the West African countries' economic partnership agreements with the European Union?
Moi, je vois pas d'avantage.
I see no benefit in this cooperation because our countries do not produce. What the European countries want us to do is to open many of our markets to them in order to take our resources. The only thing African countries have to do is to transform our mineral and raw materials here in Africa, but not to send them to Europe where they are processed and resold to us at higher prices. As long as we continue to sell our raw materials, we will always depend on the international economy.
ECOWAS citizens already enjoy the right to move freely within the ECOWAS area without visa since 1979. But in practice, there are still many obstacles that impede the free movement of people and goods. For Dr. Suleiman, ECOWAS Biometric National Identity Card Initiative, expected to replace the existing regional travel certificate in 2015, will maybe further enhance the regional integration. Desiree Canon, CCTV, Dakar, Senegal.
Now, the 7th Economic Community of West African States trade fair in the Ghanaian capital of Accra is drawing to a close. The theme in 2013 is regional integration through trade. Fairly common theme across Africa. More than 700 manufacturers, traders and industrialists from across West Africa gathered to provide a showcase for business opportunities within the 12-member trading bloc. The West African countries want to essentially emulate the EU by strengthening their political and economic ties, as well as promoting inter- and intra-bloc trade. Intra-regional trade among ECOWAS countries remains a major difficulty, with companies hoping to do business across the sub-region still facing high import tariffs and quite a bit of harassment and extortion at the borders. The ECOWAS Commission has already introduced a scheme to liberalize trade, but its implementation so far has been quite slow.
The founding fathers of ECOWAS have come to realize that we need to remove such barriers to trade among ourselves. We have a lot of natural resources that if we harness it, we will be one of the economic giants in the world.
For me, I think it's a great idea for West African countries to come together to showcase what they have, to showcase our traditions in different ways, and so I think it's interesting. It's a great idea.
We came directly from Malaysia and we established a permanent office in Dubai, okay, but we also have in Africa, around Africa, so first time in Ghana, okay, but it's very good.
The self-made South African millionaire Herman Mashaba has again lashed out at governments across the continent for not doing enough to support young entrepreneurs among their citizens. Mashaba is the founder and chief executive of the iconic Black Like Me hair product range. He was speaking at the World Retail Congress in Johannesburg. Mashaba is one of South Africa's first black entrepreneurs. He started his business over 30 years ago with a loan from a friend. He currently owns a billion-dollar empire that's steadily growing across Africa and abroad. He spoke to CCTV Sumitra Naidu about the challenges facing new African entrepreneurs.
You know, for some of us, we thought in 1994 that we're going to really see an emergence of entrepreneurs, particularly black. And then 20 years down the line, how come it has not really happened? Yes, we sit in a country, we've got to really be proud of our environment and our constitution, but then within that constitution, within our constitution, we've got really issues that are really driving entrepreneurs not to succeed. One of them being this, what I call draconian labor legislation. You know, we come from the past where our people were not really protected and totally exploited.
Now, China's Singles Day. Today it started out as a celebration for the unattached, and it has created one of the world's biggest online shopping phenomena. Online shopping in China is now reported to have exceeded the two biggest shopping days in the US combined. You're looking at Black Friday and Cyber Monday, both dwarfed by the estimated $5 billion in one day of shopping in China. China's Singles Day was started by the e-commerce giant Alibaba, which does not sell merchandise itself, but it offers a platform essentially for vendors through Tmall and Taobao. Alibaba, though, offers an online payment system which helps Chinese consumers to buy and spend online. Right then, quick run through the markets here for you. It's a day really of marginal gains across Africa, except for Egypt, starting in Nigeria. The all-share index ending the day in the green, but only marginally so, by less than a tenth there, really. In South Africa, pretty much the same story with the all-share index up by 0.07%. Pretty much the same story in the 20-share index in Kenya, down under the 5,000-point mark at 0.09%, 4940.32, the relevant number there. And the Egyptian market ending the day in the red, down half a percentage point. That's business for you this Monday. More 1000 GMT tomorrow.